Okay, still you and me. Oh, there's a couple coming in. Hi, everyone. Welcome. We're going to wait a few minutes for some people to come in and then we'll get started. All right. Hi, everyone. Thanks for joining us. My name is Maria Sharp. I'm the Business Development Associate at HBC. I just wanted to welcome everyone for being here. As you know, we are living in a crazy time, but our mission continues to help small businesses grow. Our physical office is closed for the time being, but we are still working via phone and video conferencing. If you would like to schedule an appointment, please reach out to us. We've also created an emergency phone response system where you can speak to someone from our team within an hour about COVID-19 small business resources. In addition to our regular trainings, we have launched a webinar series called Business as Unusual. The series occurs every Friday at 11 a.m. This week, we have a local restaurant owner joining us. Today, we have the pleasure of having Raymond Graves with us. Ray is the lead lender relations specialist in our SBA Cleveland District office. If you have any questions throughout the presentation, just submit them in the Q&A or chat box, and we will get to them as we can. And we'll be sending out a replay of this webinar after it's over. All right, Ray, take it away.
Great, thank you so much. Thanks to the Hispanic Business Center for having me and continuing to do these sorts of outreach programs even during this this strange and unusual time. So I am Ray Graves with the U.S. Small Business Administration. I have about 20 slides to go through today, so hopefully we can get through those in about an hour. Delighted to take your questions. In fact, you know, if you've got something pressing, you know, please do submit it to the Q&A because I don't have any problem being interrupted, and sometimes I can get going downhill and people get confused, and please submit those. So just to start with, the Cleveland SBA District Office has about 10 employees. We are responsible for, you know, lender outreach and entrepreneurial outreach in the Northern Ohio community. Of course, headquarters is in Washington, and we have an administrator, Jovita Carranza, who reports to the president. What we do is we power the American dream. we make the American dream of business ownership a reality. We empower entrepreneurs and small business owners with the resources and support they need to grow their businesses. And we're the go-to resource and voice for small business that's backed by the strength and reach of the federal government. No matter what stage you're on in your business journey, SBA has a solution for you, starting, growing, expanding, and if you need to, recovering your business. We're going to be talking about funding your business today. We're going to touch on the COVID-19 response, but this program isn't directed necessarily specifically towards the COVID-19 response. It's what's sort of dominating the news, but this is more of a general program, intended to be more of a general program about funding your business. So what we're going to be covering includes background in the SBA, which I talked about a little bit a second ago. We're going to be talking about the SBA's loan programs. We're going to talk about a little bit about business planning and the lending process. So questions like, how do I get a loan? What documents are required? A frequent one is, how much money can I get? And how much time will it take? So hopefully we'll touch on each of those. If I screw that up and we miss something, then you'll be able to ask the question and make sure you keep me on track. So first, to address the news of the day, the COVID-19 crisis. As you probably are aware, with SBA in the news so much, we have been on the forefront of the federal government's response to the crisis with providing access to capital to small businesses. And the programs that we have at our disposal include the SBA debt relief, the economic injury disaster loan, and the paycheck protection program. So SBA debt relief is pretty simple. If you've got an SBA loan or you get an SBA loan, and here we're talking about your sort of typical SBA loans that were available pre-crisis, SBA is going to be making 6 months of payments for you, which is pretty nice. It's going to get you from from here to there. It's going to be very helpful as far as getting through this 6-month period or so. If you have an SBA loan and you haven't talked to your lender, or you're continuing to make payments April, May, et cetera, you really need to talk to your lender right away to make sure that they're aware that this debt relief is out there. And what's happening in the background, of course, is that the bank that you've got a loan from is actually going to bill the federal government for your loan payment, but you shouldn't have to make it. And this doesn't have anything to do with a deferment that you may have received as well. So you could take the SBA's debt relief after your deferment ends, or you could take a deferment after the debt relief ends. It's at your choice. Economic injury disaster loans was the specific disaster program we had available at the start of the crisis. These are direct loans from the government, and you would apply for them through sba.gov/disaster. These are working capital loans that are designed to get a company from one side of the crisis to the other. So think of it in terms of 6 to 18 months of working capital, and that would be for things like accounts payable or rent or interest or debt payments. It could be payroll. It could be a lot of different things, but it's not to replace revenue or profits. It is to pay expenses that the business would have otherwise been able to pay. So you might think of it in terms of, this is going to give me, 12 months of working capital to pay my rent and to pay down my accounts payable, so I don't get overdue on those. That would be a typical EIDL loan. The nice thing about these loans is you get 30 years to repay it, which is traditionally like a home mortgage or something. You usually got a long time to repay a home mortgage or a real estate loan because the asset appreciates in value. So lenders are pretty happy to make a really long-term loan. On a collateral loan on a loan like this that has no collateral, just working capital, the 30-year repayment is extremely rare. And so this is a really good deal. It is not a grant, but it is giving a small business owner a very, very long time to pay off obligations that they previously had. It allows them to satisfy their creditors and their obligors, but it is a loan. So there's no collateral up to $25,000. You'll take personal guarantees over $200,000. Again, this is a loan that would be collateralized again only if the loan is above $25,000, and the collateral in this case would be just a business assets filing. Personal guarantees, of course, would be engaged on that higher figure. These loans could go up to $2 million. Now, as part of EIDL, as part of the CARES Act, the agency was authorized to make $10,000 as an advance grant on that EIDL loan. So if you apply through sba.gov/disaster, you can actually ask for a grant in advance, and that grant is based on employees that the company is sharing, and it could go up to $10,000, and that does not need to be repaid. Those are going out pretty quickly. But the EIDL program in general is very heavily oversubscribed. We had millions of applicants, and so it is certainly taking the agency a little while to work through the queue on those. It's not unusual for people to be waiting for any kind of contact from the government. The Paycheck Protection Program, the PPP, is another creation of the CARES Act. It's designed to allow businesses to rehire employees that maybe they would have otherwise had to lay off. So it's a forgivable loan intended to bring employees back on payroll. To the extent that the funds are used for payroll, the loan can be completely forgiven. So it can go from a loan to a grant in most circumstances. Eligible uses include payroll, rent, utilities, and interest on debt. But by and large, employers are going to use this for payroll to make sure it's forgivable. Guaranteed loans. These are guaranteed loans that are made through banks. So in contrast with EIDL, which is a direct loan from the government, the PPP loans are always through a bank. The SBA is guaranteeing that loan. The amount to be forgiven, any amount that's not forgiven, I should say, is amortized over 18 months at a 1% annual rate of interest. So even if your loan here is not 100% forgiven, you would have quite a long period relative to the loan size at a very, very reasonable interest rate to pay the thing off. So with that, I didn't want to, really focus on this with the other, 15 slides we have. So maybe I'll stop right here and see if there are any questions on these programs specifically before we sort of move on to the more general topic of access to capital and getting funding. Are there any questions? I can't see any kind of queue, so.
No, there are not. Oh, there's one right now.
Okay.
Are any geared towards startup businesses?
I think for each of the, well, for EIDL and for PPP, you have to be in business, I think as of like February to get access to it. For the SBA debt relief, that would be applicable to a startup business. So if somebody was able to go to a bank right now and get a bank loan, they would have 6 months of payments made by SBA. So that would go for new businesses as well. In the first round of PPP, the agency went through about 1.7 million loans, $342 billion, and supported 5,000 lenders. In the second round, we are about at 180 billion right now, with 5,000 lenders participating and 2.2 million loans through this program. So it is a remarkable amount of volume. And for as much criticism, I think, as the agency has in some cases correctly taken on some of these things, it's also the truth that the agency has done an incredible job of making access to capital available for these programs. The numbers speak for themselves, and it's just a massive, massive undertaking for the agency right now to deliver on all of these loans and loan guarantees. It also gives you a sense of the size of the small business economy, that millions of businesses are needing and accessing this kind of subsidy. So pivoting now to the SBA's general loan programs, the ones that are available all the time. The SBA typically provides loan guarantees, and these range from 50% of the loan up to 90% of the loan. The lender receives a guarantee from the federal government on the loan, which shields them from loss. A guarantee from the government means that if a bank makes a loan to you as a small business and you don't pay the bank back, well, the bank can recover as much as they can on whatever collateral they have, and then they'll send a bill for whatever the balance is to the government. And the government will turn around and pay a portion of that loss based on whatever the original guarantee percentage was. Most SBA loans have a 50% guarantee because most are done through this program called SBA Express. But it's certainly possible for a higher guarantee percentage to be there as well. Fees on an SBA loan are generally related to the guarantee portion and are around 3% of that. Expect that to be an additional cost if you're getting an SBA guaranteed loan. The interest rates on these loans generally are around prime plus 3 to 5%. Terms are typically 5 years out to 25 years. 5 years would be like a working capital loan for accounts payable or startup costs or something like that, and 25 years for real estate. SBA loans are always fully amortizing, meaning if the note says that you have 10 years to pay off the loan, that you truly have 10 years to pay off the loan. It's not a question of paying as if you had 10 years, but then at year 5, the bank somehow would have some option to yank the loan. That's not the case on an SBA loan. They don't have a call feature or anything like that. The only way a bank could demand full repayment is if you stop paying them. Otherwise, the loan is fully amortizing, meaning the term of the loan is the amount of time you actually have to pay. There's no prepayment penalty on any SBA loan under 15 years. Over 15 years, there's a modest prepayment penalty, which we call a subsidy recoupment fee. We also have a program called the 504 program, which is a long-term, low down payment, fixed interest rate loan for major capital intensive projects. So if you want to buy a piece of real estate, you want to buy a factory, something like the 504 program can really be a good option for you because it allows for access to the bond market. And rates in the bond market are very, very low. You can get long-term fixed rate financing extremely cheaply through the 504 program, but it is only for real estate acquisition and typically projects of $250,000 and up. If you have a project that's lower than that, it probably doesn't make sense to go through sort of the mechanics of a bond market program. And in most cases, people are just getting the 7(a) loan guarantees in those cases. Finally, there is something called an SBA microloan, which is also an SBA program, but it's an alternative financial tool for non-bankable clients. So many people that are looking, say, for a $25,000 loan are able to go to a bank and get conventional financing. Or if they can't get conventional financing, they may go to a bank and get an SBA guaranteed loan, like I mentioned in the first bullet point. But if they can't, for example, maybe there's an individual who's coming off of a deployment overseas, and maybe their credit is bad, or maybe it's an ex-offender coming back from incarceration who wants to start a business, or maybe it's someone who has had a medical bankruptcy or a divorce, or any of the millions of things that can happen to an individual that causes credit to be poor. The SBA microloan program is our program designed to address that need. We fund organizations across the country that provide these microloans, and these microloans are generally, not as low a rate of interest as a bank, but certainly better than maybe a credit card or a fintech loan, and can help fund startups or, low-income areas or minority or women-owned businesses. It's a very flexible financing tool. It's always going to be for working capital, and as the name suggests, these are relatively small loans. I think our local microlender here would go up to $75,000 or more, but typically a microloan is, $5, $10, $15,000, enough money to get a startup business a few months of working capital, a little bit of a cushion so they can start their business. These programs are necessary because banks are a traditional way of getting funding out to small businesses in this country, and banks want a sure thing. Banks want to be assured that 99 times out of 100, when they make a loan to a small business, they're going to get paid back. They don't ask for interest rates that are 3-4 times their cost of funds. They're getting a relatively small margin, but they also want a really good assurance that they are going to get paid back. And if the business isn't able to pay them back, then they're going to want really good collateral that they can take and sell to get out of it. That's kind of what the banks want. They want a sure thing. So small businesses are not a sure thing. Sometimes they lack reserves to get them through a tough period. Sometimes they lack track records, so it's tough to underwrite whether they'll be successful or not. Sometimes there's only 1 or 2 key managers, and life happens, and the manager has to move away, or someone gets sick or something like that and can't be at the business, and that's a critical challenge to a business. It can't run without its key managers, and there's just no one else. Sometimes they're very exposed to competition. They're a coffee shop or something that's doing fine until Starbucks moves in next door, and people just think Starbucks is better, even though there's nothing wrong with that small business whatsoever. Um, they're just muscled out of the marketplace. Sometimes they're exposed to economic cycles, like a lot of our small business base are like contractors and tradesmen. And in good times, when people have lots of cash, those businesses do very well. But in bad times, one of the first things people stop paying for is, brand new marble countertops, or some kind of new fancy range or something that needs to be installed. They're just going to say, we're good with what we've got. And in those situations, many of the contractors and tradesmen suffer because those kinds of products can be deferred. Sometimes these businesses lack financial controls because there's one owner and they're not necessarily an accountant. They don't have the money to pay a CFO, so they just don't have good financial records. So for all of these reasons, banks look at small businesses being risky. The reason that the SBA exists is because we help alleviate that bank risk by providing guarantees on their loans. So I want to talk a little bit about eligibility on SBA loans. To be eligible for an SBA loan, you have to be small, for-profit, doing business in the United States. You have to have reasonable invested equity. You have to use alternative financial resources to the extent that you can. So the government doesn't want to be involved in providing financing if a business doesn't need us. That's not the way that America is supposed to work. If you can get where you're going without needing help from the government, you should do that. So you need to be able to demonstrate a need. You need to have use the funds for a business purpose and not be delinquent on any existing obligations to the government. We do not make loans for lenders, developers, and landlords, for foreign-owned entities, pyramid schemes, gambling businesses, discriminating businesses, religious businesses, indecent businesses, lobbyists, or speculative businesses. Some of this has changed a little bit through the CARES Act with the PPP program, especially, and EIDL as well, being able to, in some cases, provide assistance to developers and landlords. In some cases, provide assistance to businesses that are like casinos. Even churches have been eligible for the CARES Act programs, but for your traditional SBA programs, those would be allowed. SBA loan activity is very robust. In Northern Ohio, total loans are about 1,500 loans per year under the traditional programs. So we're quite busy. There's quite a bit of business being done. As you can see in this table, for many years, Huntington National Bank has been the leader as far as providing SBA credit. But we're fortunate that KeyBank, Consumers National, Citizens, TCF, and others are also very, very active and doing dozens of loans each. You can look at this list and kind of eyeball it. Huntington, Growth, Capital Corporation, KeyBank, Consumers, Citizens, TCF, US Bank, PNC Bank, Fifth Third, and kind of see, no matter what bank you work with, if they're going to be a commercial bank, they're going to be able to do SBA loans. And so if you're needing help figuring out a good SBA lender to go to, you can certainly, call the SBA district office, or you can use our lender match program. We don't recommend any particular banks, but we can share with you who's active and make sure that you get to the right person at the bank. Typically, an SBA loan is about $250,000, but also typically, more of a median size. They're even lower than that. So if you're looking for a $60,000 or $70,000 loan, it's a very typical type of SBA deal. Going back to the microloan for a second, our contractor here in town that manages the microloan program is called ECDI, which stands for the Economic and Community Development Institute. They have a location at 7000 Euclid Avenue. Their number is 216-912-5655. Good people. Just like a bank, they will have an application process. That application process includes providing financial documentation, but unlike a bank, or unlike many banks, they really do want to hear your story, what happened with your business, what's going on with your credit. They're not just going to be, interested in sending the deal to underwriting and then seeing what can happen. They're mission oriented, and they really want to provide this access to capital to get a business started. So the rates here that they're advertising are between 7 and 12%. The loan terms are usually 6 to 60 months. So, half a year out to 5 years. It could be used to establish a business or buy equipment, leasehold improvements, but you're not going to be using this kind of small working capital loan for real estate. Their process includes an 8-step process where you're contacting ECDI, you're applying, you're providing a nominal amount for an application fee. The application is reviewed, it is underwritten, it is formally reviewed. So you do have to make a really good case that you're going to be able to pay them back, but they're going to take more risk than a bank will. And then at the end, you've got a loan closing that they schedule. So it's like a traditional loan. It's just from a not-for-profit alternative lending source. Sort of pivoting now to sort of general business planning concepts. I think it's important to have a business plan, especially when you're out thinking about how to get access to capital. And this can be an SBA program, but it need not be. There are many other sources of funds out there beyond SBA-backed funds. Certainly, you should be looking at the Cuyahoga County funds or the city funds that are out there. There's fintech. There's sourcing from the crowd. There's drawing funding from investors. No matter where you're looking for your financing, you should think about having a business plan, and that business plan should provide some information about validating your concept, evaluating your competitors, understanding what your costs of entry of the business are. It should have some preparing financial projections, and you should be able to use this living document to understand your financial statements and your projections. So a business plan isn't necessarily something that every lender is going to want to see, upfront. Some will, some won't. In most cases, remember that a banker is someone who just wants to make a loan to a business and then move on. They're not going to necessarily be interested in, all of the underlying 30-year plan of your product and why your product is better than everyone else's product. They really just kind of want enough information to assure themselves that you're a really good credit risk, that you're going to pay them back. So a loan application is not necessarily a business plan. When I was in lending, sometimes people would just say, "Hey, let me give you my business plan. It's all in there." And that would kind of be a turnoff a little bit because I know what a business plan is. It's a document that entrepreneur comes up with. It's sort of guiding their vision and gives their long-term plan and their vision statement, mission statement. I don't want to know all that stuff as a lender. Really, I just want, what are you asking for? How much money are you asking for? What are you going to use it for? How are you going to pay me back? So it's a little bit lazy to just give a lender a business plan. You really want to be tailoring it to them to make it easy on them. This is what I'm asking for. This is how I'm going to spend the money. This is the time horizon of the term of the loan I'm looking at. This is how I'm going to pay you back. And really focusing on that. That doesn't mean you don't have a business plan, but it does mean that it's not necessarily the thing you're giving to the lender on the first meeting. They may ask you for it, they may not, but what they really want is like a loan package. Always, though, a successful business and successful loan application starts with an educated and well-prepared entrepreneur. So if you don't even have a business plan, not in any form, you're almost certainly not ready to go to a lender in any case. If you need help with getting a business plan together or a loan package together, obviously you've got lots of sources of free help in this community. We're very fortunate to have the Hispanic Business Center and Randy and his colleagues, Maria as well, assisting people. But there's also, of course, the Small Business Development Centers at the Urban League at Cleveland State University. There is the Volunteer Mentorship Program at SCORE under Carlos's leadership. Danielle Sidnor at ECDI also provides training and guidance in addition to credit. So, utilizing these resources in your local library and getting yourself really prepared is critical. In Northwest Ohio, where I also do a lot of work, there is a chamber there that does good training, SCORE again. There's a Small Business Development Center at Northwest State. So lots of great options. So let's talk about the process of getting a loan. First, building expertise. That'd be writing your business plan for yourself and just really sinking into it, getting experience, working at a company of the same size and type. Not being a startup is a little facetious because if you're a startup, you're a startup, right? I understand that. Usually when I'm doing in-person discussions, people have a little bit of a laugh because how can I say, how do I get a loan by not being a startup? The thing is, it's so much easier to get a loan if you're not a startup. Once you're 2 years in business and you're showing, even on a sole proprietorship level, some level of profitability, and you can have the conversation with the lender that, hey, I'm not a startup. I know what I'm doing. It's not, how do I get started? At that point, it's a question of how can I scale up my business, which is a much better discussion to be having than I'm going to open my doors and I hope people will walk in. So not being a startup, what I mean by that is in many cases, getting a loan starts with an entrepreneur figuring out what they can do, bootstrapping with their own resources that they have right now that will get them on the road to where they want to go. not necessarily getting where they want to go right now in step one, but rather figuring out something they can do to demonstrate their concept, to make some money, to show some profitability, to demonstrate that their business is a valid business so that when they go to a lender, even if that conversation is, this is an aggressive loan for me and I'm looking at my projections as far as repayment, that's a much better discussion to have than I have no idea whether I'll have any customers or not. So just as an example, I had a guy come to me that wanted to do a brewery. And in order to get started, what his experience was and the context that he had was in the restaurant industry. He was working as a manager at a restaurant. He had great restaurant experience. So what he decided to ask for his startup loan for wasn't a $3 million brewery. It was a $200,000 small restaurant. And yes, he would be doing some brewing for that restaurant. But once he was able to get that restaurant started, get some name recognition, he was able to go to his sources of capital and say, look, I've been successful in my restaurant operation. I've built a name for um, my beer, and I'm going to now pivot to making my main business this brewery. So I'm going to go into manufacturing of beer, and that's where I think my margin is a little bit better. That's my dream. But again, he had shown business acumen. He had shown validating his concept. He had started to get a following for his product, and then pivoted towards what he really wanted to do. By the same token, I had someone who wanted to be a printer, a large format printer, and a large format press is $3 million or more. And he wasn't able to qualify for a $3 million loan right up front. But that individual said, you know what I can do is become a print broker with a very low entry cost. I can use that to demonstrate and validate that I can get jobs. And then once I have that, I'm going to go for a loan at that point for the actual equipment to bring this in-house to me, which again is a much more productive conversation to have with a lender rather than just walking in the door and saying, hey, I need $3 million, but I don't have any orders at all. I don't have any contacts. So again, not being a startup I'm not trying to be facetious. I'm trying to say, think about how you can get in business and show a profit and demonstrate your business and then pivot towards expansion. So understanding how much you can afford is critical. What cash flow do you have right now to support a loan? Because lenders fundamentally, they don't want to make guesses. They fundamentally want to say, okay, if you're generating $100 extra dollars in free cash every month, I am happy to give you a loan, the payment for which is $95 a month, let's say. And they'll make that loan to you available as a service. So you can get all of that cash flow up front to do something with it, to do something useful with it, so that you don't have to wait for 5 years to accrue all the cash to buy something. They're going to say, we'll give you the cash up front and you pay us over the next 5 years. But fundamentally, you need to understand, what is my cash flow right now? And how will that help me get a loan going forward? Additionally, understand how much equity you have to bring to the table, because a lender, no matter who they are, is going to ask you for some contribution of your own into that project. And generally, 10% is the minimum, 20% is considered a good equity injection. If you've got a $100,000 project and you have $1 to your name, that's going to be a downer for a lender. If you have a $100,000 project and you can say, I've already raised $20,000, then it's a good conversation to have. So consider for yourself not only how much existing cash flow you have, but also how much of your own contribution you're going to be able to put into this project. If you have $100, think about a $500 project. If you've got $100,000 that you can get from investors or friends or family or whatever, then you might be thinking about a $500,000 project. So try to scale that. Review and optimize your credit. Before you even talk to a lender for the first time, make sure you know what's on your credit report and know how to fix it. And there's lots of support out there for personal credit, including reputable sites online, including the FDIC site, to the small business development centers. And then once you've done those first 4 things, create a great loan package. Again, don't just give somebody your business plan and hope for the best. Make sure it's a letter to the lender that says X is the amount I'm going to be looking for, Y is the amount that I'll be using for whatever purpose. I'm bringing Z amount to the table myself. I'm ready to deposit at a moment's notice. And my projections show if I have 5 customers per day, I'll be able to make this payment with whatever. But just make sure that it's for the lender and it's succinct and to the point and business-like. Don't try to sell the lender your product. Try to sell them that you're a great credit risk. And then finally, you're selecting a lender to apply with. And I've given you some information about the lenders that are out there. If you've got credit challenges, maybe you go straight to EDCDI, or maybe you choose a community bank, or maybe you choose a large bank. But whatever you choose, you go and you make a business appointment with that lender. You make sure you're ready, and you go and you get an application. You talk with your loan officer. You get their pointers, and you move forward with the application. So some things that are in a great loan package that I recommend having include your business overview and history, your cost documents, by which I mean, if you're looking for $100,000 to build an addition to your restaurant, you really should have some kind of contractor's estimate in there showing that that's a reasonable number. You might go ahead and get an SBA application and fill it out. You don't always have to. A lender will ask you for the application if they decide you're going to go the SBA route. But if I was a banker and someone came to me with the SBA 1919 already filled out, I would feel pretty good about that, because it would mean that they had already taken the time to review the different certifications required in the SBA's application form, and they had signed off that they, for example, didn't have past due child support and things like that. That would just save me time going forward. Personal financial statement, you could use SBA's Form 413 or equivalent. Um, Business financial statements current within 90 days, income tax returns, signed personal and business for the past 3 years, projected financial statements, a statement of any ownership and affiliations you already have, your business certificate or license, certainly your resume showing that you have the skills and ability to run the business, your business's lease if you've got one. And again, last thing in there is, if you're a startup, a written business plan is a good idea to have available. But I really want you to focus in on this list rather than a business plan per se. Think about just what the lender is going to need to make their decision. If you do need help finding a lender, the SBA does have a program on its website, www.sba.gov. It's called Lender Match. So fire up your terminal and go to Fund My Business and choose Lender Match. And it's a very simple program. It just lets you enter information, and that gets spun out in email form to participating lenders. And then if they choose to have an interest in your project as you summarize it, they'll reach out to you, and you'll get the application going that way. I definitely recommend it if you've got a local lender that you work with, that you understand, a branch manager that you like, that you feel gives you good support. So, use that route first, because the human element, I think, still makes a big difference. But if you don't know anyone and you just want to say, hey, I want to spin my project out to as many lenders as possible, this is as good a way as any to go. So, questions asked of me a lot: how do I know if I'll be approved? And it's a function of your application. The most critical thing is your historical cash flow coverage, by which I mean, if you're asking a lender for a loan and the payment of it is $500, you better show that you've had $600 per month of cash flow generation in the last 12 months. Because like I said, fundamentally, lenders just want to advance you the money that you already are earning. Your personal credit, 700 is the median credit score right now in the country. So if you've got below 700, if you've got 650, you're probably going to have a little tougher time. If you've got 600 credit, you're going to have a really tough time. So lenders look really hard at personal credit and try to coach your credit up. Will you be approved if you don't have collateral? Sure. I mean, that's a little bit of an easier one, because an SBA loan's guarantee helps mitigate the lack of collateral to a great extent. Lenders will often point to lack of collateral as a reason for being turned down, but usually they're in the back of their minds really pointing towards, we don't think you're going to pay us back on a cash flow basis, because collateral can be overcome. If the issue is just a lack of collateral, SBA could provide up to an 85% guarantee in a lot of cases. Character and experience is critical as well. It is a subjective judgment, but put your best foot forward, be prepared, be well rehearsed, know exactly what you're looking for, provide your resume. If you don't have relevant experience on your resume,
Hi guys, I think we lost Ray. So hopefully he'll be back soon.
So I guess the question is sort of, would SBA like back a loan for residential care facility housing? It could. The let's see. The thing about these loans is that you can't make an SBA loan for like an apartment building, but you could make it for something like a hotel. And as you can think about, like a hotel is like where someone is staying for usually 1 or 2 nights max, whereas an apartment building, someone is staying for a year or more. So a residential care facility could work as long as it was sort of like a licensed care facility, licensed by the state, and it was a for-profit, and individuals who were staying there were receiving good, a certain level of services rather than just sort of living there. Um, um, but if it's more of an apartment setting, it would not. So I guess it kind of depends on um, exactly the nature of the business. But if you're providing care as a small business, as a for-profit business, and it's a licensed care facility, then the answer would be yes, SBA would back that loan. Next question was, thank you for the info. My friend got a grant from the SBA for a startup business for 50,000. Do you know if they still offer grants like this? No, I'm not aware of any grants for a startup business. There's something called the Small Business Innovation Research Grant Program, SBIR. Maybe that's what's being referred to. SBIRs are typically where a federal agency is offering some kind of grant to commercialize a certain product. And you can look at grants.gov and see what's out there, including the SBIR program and the STTR, the Small Business Technology Transfer Program. Usually, though, SBA's grants specifically are going towards organizations like the Hispanic Business Center, where we're providing a grant for the ongoing operation of entrepreneurial assistance. Otherwise, there's just way too many applicants for grants. We'll sometimes do competitive grants. Like there was an Innovate Her program that came out years ago that provided, I think, some small grants, but that was on a national competition basis. What else is there? I guess those were the 2 questions there. Let me see if there's anything else. Yeah, I think Celine was asking again about, she has certifications from some government source there. I don't really know who that is, but it seemed like, yeah, you would be eligible for a small business loan as long as you're past the eligibility tests and as long as uh, the individuals who are at the location are what they call transients. So they're going to stay for a short period of time and then move on rather than it being any kind of a permanent living arrangement. But the main thing is you're going to have to convince the lender that it's a good credit risk. The eligibility piece of it, again, being small, for profit, um, in most cases, if you're not a landlord and you're not a passive business, you'll be okay there. So should be okay. All right. Anybody else?
Looks like there was a couple. I don't know if you can see them. They were around 1 o'clock. Well, I guess it is still around that hour. They said, is the SBA only geared toward businesses that are already established, or does the SBA help businesses that are trying to start up?
Both. About 1/5 of our lending goes to startup businesses. So it's certainly the case that it's a lot easier to get a loan for an existing business that's expanding, but our guarantees do not discriminate against startups whatsoever. Um, in fact, I think we probably help a majority of the startup businesses out there get started. It's just a tough road to hoe. Um, Businesses that are startups are almost always going to be getting an SBA guarantee, but it's going to be a tougher thing.
Gotcha. And then someone asked, what's reasonable invested equity?
Mhm. Reasonable invested equity is going to be about 10 to 20% of the project, but lenders are going to be making that case themselves. So if you've got a $100,000 project and you're asking the bank for $99,000 of debt, and you're going to be putting in $1,000 of equity, that's probably not reasonable. That's 99% bank, 1% you. You should be looking for, a reasonable invested equity for most lenders means 10% equity injection on a given project. But in some cases, it might be different. If your business, you've invested in the business significantly over time, and it's got a net worth of $100,000, and you can see that in the equipment that is on the shop floor, and you're looking for $25,000 for another piece of equipment, a lender might just say, hey, we're going to go ahead and fund 100% of that project because the reasonable invested equity that we see is all over the shop. It's money that you've already put in, and maybe it's free and clear, and we can take a lien on it. So it just kind of depends, but 10% is normal.
Gotcha. All right. I think that's all the questions. So thank you for joining us. And yeah, thanks everyone for being here.
Okay. Well, thank you for having me. I appreciate that.
All right. Have a good one. Bye, guys.
Okay. Take care.